Every major financial crash in the last 100 years followed this progression. Not a similar rhythm, not a loose resemblance. The same five-stage sequence that appears long before the collapse. 1929 followed it, 1987 followed it, 2000 followed it, and 2008 followed it. The sequence begins quietly, builds under the surface, and by the time the final stage arrives, the options that once existed are already gone, and the cost of reversing course exceeds the capacity of most participants to absorb it. Wall Street knows this pattern, and the Federal Reserve knows it. The people who manage money for billionaires definitely know it, and they adjust long before anyone announces trouble. But you have probably never heard of it, because if regular people understood what to look for, they would pull their money out before the crash instead of after. And most people stay exposed until the exits narrow. Once enough capital is committed under the assumption of safety, reversing quickly becomes impossible without destabilizing prices. I am going to walk you through all 5 stages, and as we move through them, you will see where we are in that sequence right now. Further along than most people think, closer to the narrowing than to the beginning. In 1929, a man named Roger Babson stood at a business conference and made a decision that cost him his reputation overnight. He said 9 words. Sooner or later, a crash is coming, and it may be terrific. The room turned on him immediately, and the audience laughed. Newspapers mocked him. Irving Fisher, the most celebrated economist of the era, publicly dismissed him and declared that stocks had reached a permanently high plateau, a statement that locked his credibility to the continuation of the boom. By tying his reputation to the permanence of rising prices, he eliminated the option of retreat without public humiliation. From that point, the only way to preserve his authority was to remain committed to the plateau. 47 days later, the market collapsed. Fisher lost everything and never recovered his standing. And once his fortune was tied to leveraged positions, liquidation meant permanent damage rather than temporary setback. Babson, who had already positioned himself defensively, made a fortune, and later founded a college that still exists today. The divergence did not happen at the crash. It happened when each man chose whether to treat the warning signs as binding constraints or temporary noise. And once their capital was positioned, reversing course required absorbing losses they were unwilling to accept. Babson was not guessing. He had built a systematic method for analyzing financial conditions, focusing on credit levels, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors that moved in order, tightening the system step by step. I spent 3 months combing through historical records, Federal Reserve data, and academic papers to test whether his framework held across different crashes. And every time, the same progression appeared, with each stage degrading an option the public assumed still existed, forcing later actors to operate within constraints set earlier. Stage 1 is the credit explosion, and it always begins here. Not with greed, not with speculation, but with debt expanding faster than the economy can absorb it, binding future income to present prices. Once income streams are pledged forward, flexibility disappears. People borrow money they cannot realistically repay, and use that borrowed money to buy assets, which pushes prices up and makes them feel wealthy, which encourages them to borrow more, locking them into a feedback loop that feels like prosperity while quietly removing their ability to step away without loss. As leverage rises, even a small price decline makes voluntary exit impossible, turning hesitation into forced action. In the late 1920s, margin debt exploded. Ordinary Americans put down 10% and borrowed 90% to buy stocks, a leverage ratio that meant even a modest decline would wipe them out. By 1929, total margin debt equaled the entire federal budget, and factory workers were leveraged like hedge funds. Once prices began to slip, their collateral no longer covered their obligations, so holding was no longer an option. They were forced to sell, and the selling accelerated the fall. Forced liquidation removed the possibility of waiting for recovery. In 2007, it was mortgage debt. Banks created instruments that let people buy homes with no money down, then packaged those mortgages into securities and sold them to pension funds, spreading the leverage across the system while disguising it as diversification. Once those securities were distributed globally, unwinding exposure required widespread recognition of losses that institutions were structurally incentivized to delay. When housing prices stopped rising, borrowers could not refinance. Defaults increased, and the securities built on those loans collapsed in value, pulling down institutions that had no clean way out because their capital buffers had already been pledged. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion and used stock as collateral. When stock prices fell, the collateral evaporated and the debt remained, and the entire structure imploded, because the borrowing had already committed future cash flows that never arrived. Once debt service exceeded operating capacity, restructuring meant dilution or bankruptcy, and continuation without growth was no longer viable. Now look at where we are. Official margin debt sits around $750 billion, but it captures only a slice of the leverage embedded in the system. Securities-based lending adds roughly another $800 billion tied directly to portfolio values. Options markets amplify exposure far beyond the cash invested, forcing hedges that reduce tolerance for volatility. Corporate debt has ballooned to over $10 trillion, much of it used to buy back stock rather than build productive capacity, committing companies to fixed obligations that do not shrink when revenue slows. Government debt is now over $34 trillion, with interest costs larger than the defense budget, tying fiscal policy to rising financing costs. As a percentage of GDP, total debt in the American economy is higher than it was in 1929, higher than in 2008, higher than any point in recorded history. And each additional dollar borrowed narrows the room to maneuver if growth falters. Stage 1 is not theoretical. It is active, and it binds future flexibility to present valuations. As long as valuations hold, the pressure remains contained. But once they weaken, the commitments made under optimism convert into obligations that cannot be deferred. Stage 2 is the concentration trap. Crashes do not occur simply because prices are high. They occur because risk concentrates into a small number of assets that carry a disproportionate share of the market's value, so that when one stumbles, it drags everything else with it, removing the illusion of diversification in a single move. Once portfolios depend on the same narrow leaders, independent outcomes cease to exist. In 1929, a handful of glamour stocks dominated the market. Radio Corporation of America rose from under $2 to over $500 in a few years. And investors bought not because they understood radio technology, but because the price kept rising. RCA became such a large portion of the market that when it cracked, the index could not absorb the blow. And once the largest weight declined, selling pressure spread mechanically, leaving no unaffected refuge inside the index. In 2000, the Nasdaq was effectively a bet on a small cluster of technology companies: Cisco, Intel, Microsoft, and others. When those leaders rolled over, trillions in wealth vanished because the index had concentrated exposure in a narrow slice of the economy, and once leadership failed, capital rotation had nowhere broad enough to offset the decline. In 2008, concentration hid inside the banking system. 5 banks held the majority of derivatives exposure, and when Lehman failed, the interconnected obligations nearly brought down the entire structure, because the risk had pooled where it could not be easily unwound. Once counterparty trust broke, even solvent institutions faced funding pressure, and interbank lending froze. Today, the concentration is visible. The top 7 stocks in the S&P 500 account for over 30% of the entire index, at times closer to 35%. When someone buys an S&P 500 index fund, sitting in most 401ks and retirement accounts, they are not purchasing equal slices of 500 companies. They are placing a massive bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 drop 50%, the index falls 15 to 20%, even if the other 493 companies hold steady. And because passive investing automatically allocates more capital to the largest names, each new dollar flowing in amplifies the concentration, increasing the weight of the leaders and reducing the system's resilience if sentiment shifts. Once flows reverse, the same mechanism forces disproportionate selling in the largest positions, compressing the time available to stabilize. Once that concentration is built into automatic allocation, there is no exit that does not unwind the same few names first. On the way up, this mechanism reinforces gains, but on the way down, it forces selling in the largest positions first, accelerating losses and shrinking the time available to respond. Once outflows begin slowing, them requires renewed inflows at scale, which depend on confidence already damaged. Stage 3 is the smart money exit, and it marks the point where information asymmetry becomes decisive. Before every major crash, institutional investors begin reducing exposure, selling positions, raising cash, buying protection, while public statements remain optimistic, locking regular investors into the trade. Once insiders lighten positions, they regain optionality that others surrender. In 1929, the Morgans and the Rockefellers began liquidating in the summer, and Bernard Baruch was almost entirely in cash by September. Joseph Kennedy sold after his famous shoeshine boy conversation, but the deeper reason was access. He knew what was happening inside the banks. By the time October arrived, the wealthy had already reduced their exposure, and regular Americans still buying became the exit liquidity. Once prices began falling, those who had not exited faced margin calls without the cash reserves to absorb them. In 2007, hedge funds started shorting subprime mortgages, a year before the crash. Goldman Sachs bet against securities it was selling to clients, and executives at mortgage lenders dumped personal stock while reassuring investors. The pattern repeated. Insiders shifted risk outward before the public realized conditions had changed. And once losses surfaced, the burden remained with those who entered last. Today, corporate insider selling has reached levels not seen in decades. CEOs, CFOs, and board members, people with direct knowledge of company conditions, are selling at a historic pace, with ratios of insider selling to buying at extreme levels. At the same time, retail investors continue pouring money into markets through brokerage apps, retirement contributions, and passive flows. The shift is not dramatic in headlines, but it is decisive in direction. Those closest to the information are lightening exposure, and those furthest from it are increasing theirs. As that transfer completes, the capacity to exit without moving prices diminishes. Stage 4 is the liquidity illusion, and this is where the surface calm becomes most deceptive. Prices may remain stable or even rise. Volumes may look healthy. And yet the liquidity that allows markets to absorb shocks quietly drains away. Once liquidity thins, the system's ability to absorb error contracts. Liquidity is the system's ability to match buyers and sellers without violent price moves. When it is abundant, shocks are absorbed gradually. When it thins, prices gap. Small orders move markets disproportionately, and feedback loops amplify every imbalance. Once participants recognize thinning liquidity, they demand wider spreads, which further reduces depth. In 1928 and 1929, the Federal Reserve raised interest rates to cool speculation, tightening monetary conditions and reducing the liquidity supporting asset prices. By raising rates, the Fed committed to restraint that could not be reversed quickly without signaling panic. For months, nothing appeared to break, and the market continued rising, encouraging the belief that tightening had no real consequence. Then October arrived, and when selling began, bids disappeared. Prices did not decline in orderly fashion. They collapsed, because the buyers were gone. And once confidence broke, restoring liquidity required policy shifts that came too late. In 2007 and 2008, the Fed raised rates and credit conditions tightened. But housing prices and equities held up long enough for complacency to set in. When Bear Stearns failed and then Lehman, the liquidity that had been assumed to exist evaporated, and markets fell 50% within months, because the support had already been withdrawn. Once interbank trust dissolved, reopening lending channels required extraordinary intervention. Today, the Federal Reserve has raised rates at the fastest pace in 40 years, from 0 to over 5% in less than 2 years, while running quantitative tightening and pulling hundreds of billions out of the financial system. By tightening aggressively, the Fed reduced its own flexibility. Reversing too quickly risks credibility, while maintaining restraint strains balance sheets. Markets remain near all-time highs, which many interpret as evidence of control, but control is constrained. In March 2023, Silicon Valley Bank, Signature Bank, and First Republic failed within a week. Not because of fraud, but because rising rates created liquidity crises. The Fed introduced emergency lending programs to stabilize the system, while maintaining that it was not a bailout, effectively trading future flexibility for immediate containment. Once those facilities were opened, market participants adjusted behavior around their existence. After that intervention, tightening could no longer proceed as if the same pressures would not reappear. Those programs are temporary, and the underlying rate structure remains. The Treasury market, the foundation of global finance, has shown moments of severe stress, with liquidity nearly evaporating in what is supposed to be the most liquid market in the world. The surface holds and the plumbing strains. If Treasury liquidity falters, every asset priced relative to it inherits that instability. Stage 5 is the trigger. It cannot be predicted in advance, and that unpredictability is what closes the final door. The trigger does not cause the crash. Stages 1 through 4 create the fragility. The trigger determines the timing, and once it arrives, the accumulated constraints activate simultaneously. In 1929, the arrest of Clarence Hatry, a British financier, forced British banks to raise cash and sell American investments, creating a cascade of selling that ignited a system already weakened. Once selling began in earnest, stabilizing prices required buyers willing to absorb losses in an environment where credit had already tightened. In 2008, Lehman Brothers became the spark, but any number of institutions could have played the role because the structure was primed. Once Lehman failed, counterparties reassessed exposure everywhere, freezing transactions that had previously rolled automatically. This time, the trigger will not be the cause. It will be the moment counterparties question settlement. The derivatives market alone represents over $600 trillion in notional value, and a single major counterparty failure can force rapid repricing through interconnected obligations. Regional banks, commercial real estate exposures, and sovereign debt stress. Any of these can become ignition points once collateral is questioned. Once settlement is doubted, even routine transactions slow. What history shows is this: when stages 1 through 4 align, the trigger tends to arrive within 12 to 24 months. All 4 preceding stages have been active since late 2024, placing the window in 2025 or 2026 narrowing as time passes. As the window narrows, delaying preparation reduces available adjustments. This does not mean the market crashes tomorrow. Timing remains uncertain, and markets can stay elevated longer than expected. But the conditions that preceded every major crash in the last century are present now, and once the trigger hits, the ability to reposition rapidly disappears. Because liquidity, concentration, leverage, and informational asymmetry converge at once. Roger Babson prepared before the crash, holding cash and buying hard assets while others leveraged to the peak. By positioning early, he preserved the option to deploy capital after prices reset. Irving Fisher trusted the plateau and lost his fortune, reputation, and legacy, spending the rest of his life attempting to recover. Once his capital was destroyed, recovery depended on rebuilding from diminished resources. The difference was not intelligence. It was whether they treated the pattern as binding. And once positions were set, the outcome followed the structure already in place. You face the same narrowing. Markets may recover eventually, but the path between here and there can destroy decades of savings if exposure is concentrated and leveraged. Retirement accounts, brokerage holdings, and home equity in overheated markets. Much of it is tied to asset prices that assume continued perfection. If those assumptions break, restoring prior balances requires either time or new capital. If the market drops 50% over 18 months, as it did in 2008, the consequences will not be abstract. Plans will be delayed and security will shrink. Options that feel open today will close quickly, and reopening them will require conditions not immediately available. I am not a financial advisor. I study patterns, and this pattern is clear. The people destroyed in crashes are rarely foolish. They are unprepared. They assume institutions are fully in control and believe someone will issue a clear warning before real danger arrives. Once they recognize the shift, the capacity to act has already narrowed. In 1929, no one issued a final alert, and in 2008, no one stopped the chain reaction before it began. The warning is the pattern itself, and now you see it. Seeing it does not reverse it, it only clarifies the structure already advancing. What you do next determines whether you stand inside the narrowing or step aside before the door closes. The crash of 1929 did not need to destroy so many lives. The signals were there, and the sequence had already advanced. People chose not to recognize it until their choices were gone. Don't make the same choice.